go here, it is worth millions of dollars. What we're going to be doing is taking a look at the S&P 500 and drawing in the new updated version of the road to financial freedom. This is like the most simple chart that you need to have. With this chart, it can help you understand how expensive the stock market is relative to the past or how cheap it is in a moment's notice. So it is like the most simple, easy to understand chart there is. All right. So we're going in version 2. So this is the most up-to-date chart that I have made. And honestly, I believe it's probably like the best chart, honestly, that I have seen on the internet. If you're aware of a better, more simple chart and effective chart than this, please post a link down below because I'll be happily proven wrong. I really do believe that this is the best chart there is. All right. So first of all, what we're going to be doing is taking a look at version 1. Version 1, all we need to really look at is ignore the COVID crash, ignore the red arrow, just take a look at these 3 lines here. So we're looking at the green line, the white dotted line, and the red line at the top there. So very simply, this was version 1. The green line represented when the stock market, when the S&P 500 was historically extremely cheap, right? It's extremely cheap. The white line is like fair price, right? The white dotted line is fair price. And whenever we go above that, closer to the red line or above the red line, that is when it is historically expensive. So what you need to do is just draw in those 3 lines first. I'll help you, like I'll zoom out here and help you connect the dots and take a look. So the reason why I think it's really important is because I think there has been a trend since the last major financial crisis in 2008. I think the market went, really downhill, minus 55%. That was a proper bear market. And since then, since 2008, the stock market, yeah, it has gone. Like some people say the definition of a bear market is minus 20% or above. Um, overall, there hasn't been really a proper bear market ever since then. Like that 2008, that was serious, right? Yeah, you can say the same thing with 2020. It was extremely fast, but it was over and done with like within a month. And it actually didn't really ruin this road to financial freedom chart. So I think if what I like about this chart is if you just follow it, and as long as it doesn't break, I think maybe one day in the future it will break. But for now, it's held up since 2008. That is many years. That's multiple decades at this point, right? So it doesn't mean it has to hold forever. Everything can change. Obviously, it cannot tell the future, but I like it because it's one of those charts where you just look at it. As long as it's following the lines, as long as it's following the trend, you can just stay confident. And then if the market crashes, like right now with the S&P 500, everybody's there getting all scared about Donald Trump's tariffs and all of this stuff. But well, if we zoom out and look at this chart, it's put it back into perspective. Like, what's actually happening here? Like you can barely even see the red little dip that we've gone to, right? And let's just say we did dip, right? Like a lot of people are saying, oh, should we exit out of the market? The market's really volatile at the moment. Yeah, it's going up and down. But I wouldn't say this is any bigger than this or this or this. You know what I mean? Like they're all the same size, right? So the emotions can get to our head. But imagine this, like a way to interpret it is like, why would you want to sell here? Because if we did move from here down to here, right? We're just back at fair price. That's when you're supposed to buy, right? So it helps put everything in perspective. So even if we were at the red at the top here, it's like, why would you actually sell? Because from the red to it getting back to fair value where you're supposed to be a buyer, if we were to measure that, it's like only a 15% move. And 15% on your whole net worth, like you may have your whole net worth in the S&P 500 or a very significant amount. 15% feels like a lot, but we've got to understand if you've chosen to invest into the stock market, this is actually completely normal. And every now and then you go from the red top all the way down to the green. And if that does happen, it could be, 26, 30% crash, maybe a little bit more. It could go under the green line for a little bit. Remember, these lines and technical analysis in general, they're not magic lines. The market is not going to obey these lines 100% perfectly. These lines are just to help guide us, right? They're guiding lines. That's all they are. But these lines here, I would say they have a very strong weighting. Why? Because they're multiple decade-long trend lines, right? Multiple decade-long trend lines. And as well, like before you start drawing in these lines here, I'll leave it here so you can get a little glimpse of it. So before you start drawing in these lines, just right click if you're using TradingView, right click on the price on the right hand side, and then just make sure it is in logarithmic scale. So that's like a compounding scale, because if it's out of logarithmic, anything like any like stock or company, we talk in terms of percentages, right? So people each year they'll be talking like, hey, we're aiming for like 10% growth or 20% growth. Like imagine if you just grow at 10% every single year. If you plot that on a normal graph, it will go exponential, because 10% of 100 is 110, and then you go 10% of 110. I mean, so 10% of 100 is 10, right? So then you got a total of 110. You go 10% of 110 is 11, right? So now you got 121, and you keep on doing that math. It goes exponential over time. So that's just with 10%, right? And some stocks, they compound at 20%. So they're even more logarithmic. So because we're working with an asset which is logarithmic or compounding in nature, it makes sense, right? It makes sense that we need to put the chart in logarithmic, okay? So make sure it's in logarithmic. Otherwise, it's going to be going up crazy like this. So we can see the massive curve here like that. That's what a 10% thing does, right? 10% compounding over time will go into an exponential curve if you zoom out far enough. And that's exactly what the S&P 500 is. It compounds at roughly 10%. So, it's perfectly doing what it should do. So just make sure you are in logarithmic. I hope that makes sense. Now let's go look at these lines here. So what I like to do is when I'm drawing in something that's a really long multi-year trend, I like to use the ray tool. So you go to the second one from the top, you go ray, and then I'm kind of connected here. This is like 3rd of October 2011. I'm connecting it to this other low here, which is like Monday, 24th of December 2018. So you just connect those two and draw them out through there and use the ray. Okay, use the ray tool and it will project it out. Then what you do, like I can see, like it would look like this. So you start here and then you just draw it backwards, and then see how, keep an eye on this level here. Keep an eye on that level that we started at, and we just want to line it back up to there, right? And draw it back to get a bit of that history. Okay. Now you'll do the same with the top hand side. So the top hand side, I'm kind of going in through, it's not touching perfectly, but it's around March 14, 2011 here. If we zoom in, you'll be able to see it doesn't quite touch, right? There's a little bit of a gap here. And then it hugs and it does touch these levels in here at 30th of June 2014. It touches as well 22nd of December 2014. And then it runs and it has a similar gap as that first starting point. So this is 29th of January 2018. So that first starting point down here, right? So see the gap here, the gap here is similar, and then the gap here. So what that is kind of doing, I do like to start with the green one first. It is kind of like exactly the same angle as the green one. And the white dotted one, I just chuck it in there roughly, right? Just chuck it in there roughly. You don't have to make it perfect, but just eyeball it so it looks pretty much dead center in the middle of the red and the green. All right. So that's version 1. That's version 1. And we can see, what does the stock market do over time? It goes from the bottom left-hand corner to the top right-hand corner of your screen. So what does it do? Over time, the S&P 500, it's a bucket of the top 500 assets in the US, which is the strongest economy in the world in terms of a country. Over time, it just keeps on going up higher and higher and higher and higher. Why? Because the S&P 500, it has the top 500. It's a mathematical formula, and it's going to kick out the weaker assets and keep in the stronger assets. So imagine if something is 500th in that bucket and it starts to underperform, it will get kicked out automatically and replaced with something better that will enter into the bucket. So whenever we're, kind of talking about the stock market and how well individual investors are going, we're kind of indexed against the S&P 500 itself, because it's kind of like, it's very low risk. Over time, has proven itself again and again and again. And that's kind of why it is the gold standard. So you kind of say like, hey, if you think you can only make 8% with your strategy, right? Why would you do that strategy? Unless you think it's actually less volatile and less risky. That's the only reason why you would do it instead of the S&P 500. Whereas let's say you make you think you can honestly make 15%. And it's like, all right, if you believe you can make 15% compounded over time, then it's probably worth taking the crack. I'm not sure if you how much money you should allocate to that strategy. That's another topic for another day. But then it makes sense, right? So you can also relate it to your business as well. Like imagine if your business is compounding at like 6%. Is it actually worth running your business? Or should you just sell it and put all of this into the S&P 500? Because it's also the gold standard because you do nothing, right? It's actually pretty passive. The only thing you need to do is like, which is kind of the hard thing, is to remain passive. You got to remain passive and sit on your hands. That is the saying. Sometimes the smartest thing to do, probably even 95% of the time, to be honest, maybe even higher, is to just sit on your hands and do absolutely nothing. And that's really hard for us as human beings because what are we taught? What are we taught from a very young age? We are taught that to get ahead in life, we got to put in more effort. You know, it goes back to the schooling days. Like the more we study, the better the result we get. But, you know, it doesn't necessarily work with the stock market. Sometimes the best thing to do is just be wise. You know, it does take a lot of work to actually become wise. You do probably have to do a lot of research to become wise, you know, or even go through like life events or just have experience in the stock market to become wise. But after you've achieved that, then yeah, it's actually quite easy. All you need to do is just sit on your hands and do absolutely nothing, right? And then that's version one. What I want to do is talk about version two. Very simply, we just added two more lines. And, you know, I've spoken in the past, you don't want to have too many lines on your charts. You know, we're not trying to be Picasso here. We're just trying to make it very simple at a moment's notice, you know, and I think in what's his name? Is it oh, I forgot the trader's name. It's not coming to me. Is it Peter Brandt? Surely, Peter Brandt. Yeah, it's Peter Brandt. This fella here, Peter Brandt. He's got some great books on technical analysis. If you'd like to learn more, you know, it's honestly not really a skill that's, you know, kind of, you know, worth it. But if you do want to learn more about technical analysis, that's kind of a guy that he's just an absolute legend. And what he says is like, you should like when you're looking at a chart, you should be able to know what's happening within 3 seconds or less. You know, so if someone is like trying to analyze it and they're just looking at it and they're trying to find where's the gold, you know, it's like X marks the spot. You don't understand what it's about. Within 3 seconds, you should know what's happening. So right now, if we look at this chart, what is it? We can just say, hey, the S&P 500 has been going up for a multi-year decade bull run. Yes, it has some big pullbacks, but right now, if we're talking in terms of the price is slightly more expensive than fair value, but it's not extremely expensive. Simple as that, right? Very quick, right? Very quick, and we can understand based on these lines here. So now let's go to version two. I don't know if you can see on your screen. I try to make it visible, but there's a line down below the green line, and I'm going to make it so you can see it. We got the green dotted line. So all this one is connecting the COVID crash and the 2009 bottom, right? So those two bottoms. So what I'm going to say is most likely the market will probably like barely ever come here. It's like a once in a generation opportunity if the market comes down here. So just sit on that for a second, right? Sit on that for a second. The last time it touched this, I mean, the first time it touched this was in 2009. The second time it touched it was in 2020, right? Roughly a decade. Let's just say it does touch it again. Let's just say it does touch it again in like the next 10 years or so. I know a lot of people's brains are going to be thinking, oh, there's a pattern here, right? There's not. The pattern is you might be thinking, hey, 2009, 2020, that's 11 years. That means every 11 years the market has to touch this. It doesn't, right? That's not how data works. The way you find patterns in data is if the thing has happened like 1,000 times, okay? There is, you know, because it goes back to like the law of large numbers. Like when there's larger amounts of data, you can trust it. If there's 10 individual data points, you can't trust it, okay? You can't trust it. Here there's only two. So there's no trend here yet, right? There's no like you can't say every 11 years it's going to touch that line. But the way I'm going to word it is once in a generation, we're probably going to come down here and it's probably probably, all right. Obviously, I don't know. The world can change when this does happen, but it's probably the buying opportunity of a lifetime. And I highly, 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 highly doubt, unless the world is ending, I highly doubt that the price will stay down there long more than like a month. Like, I don't think it's going to be a month. Like right now, this is on a weekly chart. So all of these little candles here, they're all 1 week. So like you can see, it was a blip, right? It was less than a week that came down here, and same at the 2009 bottom, less than a week, and it just moved, all right? So the reason why I said like it's a once in a generational opportunity, and I want to sit on that again. I said that before. Let's sit on it and let it absorb, all right? Let's just let it soak in. Let it soak in here. It's once in a generation opportunity. I'm saying this and I'm taking my time to let it soak in. So hopefully you remember this in the future, because when it does come and when the market does touch this line, I guarantee you it's going to be extremely frightening. Extremely frightening. Okay. Because the market would be down quite a lot. Like the COVID one, it was down. The S&P 500 was down 35% in less than a month. Okay. 35% in less than a month. So when you got a lot of money, it's seeing 35% flash before your eyes over the course of a year or so, it is not easy, right? It is not easy, but the market loves to recover. Why? The S&P 500 loves to recover because we spoke about how it's self-cleaning, the top 500 and all of that, mathematical formula. But also, what is that? What are the companies? The companies are comprised of the wealthiest people in the world. You know, we're talking the richest. You know, if you go down the Forbes rich list, these are the owners of these companies, okay? Then if their company is down 35%, potentially even more, they're not going to say, hey, guys, let's all pack it up now. That's it. We're undefeated. That's it. We're going home. No, they're going to reignite and they're going to go harder to fix it, because no one likes losing money. Everybody wants to make more money. Like, imagine all the employees and all of that. They're scared to now lose their jobs. So, you know, the economy is probably going down. People are probably, you know, the company's probably cutting jobs. You know, and all of these companies, or most of the big ones, all of the employees, they have stock options. So they're incentivized to perform well, because the better they perform, the better the company does, and the better their shares actually do as well, right? So no one likes seeing their shares go down in value, okay? So we just got to remember, what are these things? Sometimes we can get confused, like S&P 500, that's a whole heap of weird digits, right? There's some letters and some digits, some numbers. S&P 500, what is that? No, we got to remember, right? That's just a name. That's a name for real world assets, the best 500 in the entire world. It's actually extremely special. All right, so that's the bottom line. Then the top one here, I'm gonna make it so you can see it. It's a red dotted line, and we've never actually touched this one. Okay, we've never actually ever touched this one. Um, but what I want to say is it's kind of the opposite of the green dotted line. So I kind of just eyeballed it. I literally just used a little ruler, like an actual physical ruler, and I just measured from the green dotted to the green solid line. I just did the opposite on the other side. You can see like the gap is roughly the same, right? I'm going to say if the market goes up to the red dotted line, it potentially could mean that the market is really, really, really overvalued. Um, but I don't necessarily know if it does happen that we should actually sell or not. I'm not going to give you any advice, like, and it might actually be normal in a really weird way. I actually don't know. Okay. I don't know. Um, the reason why I don't know is because if AI really starts to take over and then these companies become extremely, extremely profitable, that means, like, why would this trend hold? Right? Yeah, if the companies become even more profitable, which I think they will because of AI, I don't see how they're going to get hurt by AI. Like the top 500 companies in the world getting hurt by AI, I don't know. I can't really see it. Um, so you know, if we can agree that these companies are going to do better, they're probably going to make more profit than they did in the last 10 years. So the next 10 years are probably better, right? Then, you know, we might actually get up to the red line and it might actually be normal. So that's kind of like devil's advocate for this whole road to financial freedom chart, actually. Um, but yeah, overall, I still really like this chart, but I'm willing to ditch it, right? I don't marry, I'll say this many times, I don't marry any of my investments. I don't marry any of my investment strategies. I'm ready to ditch them in a moment's notice, okay? And the hard thing about all the stock market and this stuff is like, how do you actually interpret it? You know, so like, let's say if 10 years ago we got up to the red dot, I'm like, all right, that's probably pretty damn expensive. But in the world of AI, I just really think I'm not sure any of us know what the future looks like. I'm not sure if we know. And like past 20 or 30 years out with robots and all of this stuff, I'm not even sure if there's going to be a need for money, to be honest. Like, I think it gets pretty damn weird in 20 to 30 years. The more I look into this stuff, the more confused I get. And I'm just like, yeah, I start contemplating what is the point. But anyway, what I've come into is just like, let's just keep your head down and just keep on working, because who knows? It's better than just hoping for a future where we don't have to work. All right, that's a little bit of a tangent. Overall, that is the S&P 500 Road to Financial Freedom version 2. I hope you like it. All right. Maybe some of you are thinking, dude, that's only just what, 5 lines on a screen. How smart are you? That is actually genius, I believe. This is actually genius. If you can't see it, the simplicity, I mean, the genius is in the simplicity. Extremely effective, this chart. But remember, anything can change. So you got to be ready to be nimble and do your own research. All right, guys. Hopefully you like this one. I honestly believe it's worth millions of dollars. If you did like the video, please give me a like. I'd really appreciate it, and potentially comment down below. I'd love that. Thank you very much. I'll see you in the next one.